Let's jump in. Welcome, everyone. Thanks for joining. We're going to dive right in. I'm excited to be joined by Colin Breckbill today. We're going to talk about everything residential investing. We're going to keep it, short and tight and as compact as possible to get you in and out. The audience today here is folks who, for the most part, are kind of either accidental investors or you're new to investing or want to hear more about it. There's a lot of folks out there who want to generate passive income streams or build generational wealth. All that stuff we're going to talk about, how now is actually an amazing time to be jumping into this, and we'll give you kind of the tools to do that. So just to kick it off, kind of who we are, I'm Colin. It's great to have you here. Thanks for joining.
Appreciate it.
So yeah, Colin, give us just a little bit of background so everyone can kind of understand, where you're coming from and your kind of expertise in investing.
Certainly, and I will try to keep my cadence a little slower. I'm typically a very fast talker, but being we got 30 minutes, I'll try to stay in that cadence. Yes, I'm Colin Breckbill. I'm one of the original co-founders of Residential Capital Management, based out of Atlanta, Georgia. Our business was created in the 2008-2010 sort of real estate crisis. We were initially the acquisition arm for Colony American Homes, Tricon American Homes, Invitation Homes, based out of Atlanta, obviously being one of the prime subprime mortgage areas in the country. We amass about 18,000 single family houses. When I departed there, we were vertically integrated company where we did acquisitions, construction management, property management, and maintenance. So we created our business sort of on the backs of a lot of these institutions that were buying up this real estate. That's where we found that there was obviously some opportunity to create a successful business. ResiCap is still a very functional. They're one of the largest now build-to-rent builders in the nation, and they are national. So that's just a quick little background.
Cool. Thanks, Colin. So, and for those of you that don't know me, my name is Chris Fells. I'm the CEO and founder of Bold Street. So I come from the technology space and really ended up working with some of these names that Colin had said these are the big Wall Street companies that have bought a lot of residential properties. And we ended up creating a technology solution to basically take the power of these Wall Street companies all the way down to Main Street investors and Main Street real estate agents, property managers, the whole bit. So we're love the local real estate investor and agent, and we're going to talk a little bit more about that and how that relates to you and being able to actually build a portfolio. So just kind of quick, we're going to talk about a little bit about the environment, like why real estate investors are winning, why they've been the only folks that over the past 2.5 years, when interest rates went up, had continued to buy real estate. When kind of the family buyer market left, even the home sellers left, even big Wall Street companies left, why they've been still out there buying. We're going to talk about everyone's biggest concern, which is like, great, I'd like to do real estate investing, but I don't think it's approachable. I don't have the money to do it. We're going to talk about how you can actually do this. The underlying of everything we're doing is this is solid investment principles. This is not kind of the get rich quick scheme. This is something that you win. A lot of people say in real estate investing, it's the base hits that win. Sure, every once in a while you're going to get a home run, but when you do this, time after time, that's how you build up that portfolio that's going to build that generational wealth or that passive income. So we'll talk. I'm going to love to hear from Colin, his amazing insider strategies for success that we're going to talk about through the whole thing. And the last piece is the opportunity to join a masterclass that we put together. It's going to kick off in January to give you all of those tools to be able to get into residential investing, whether you're already kind of in it or you want to explore how to actually do this and start building a portfolio in 2025. And that first part of talking about the economics of why actually right now is a great time to start doing this. So let's jump right in. Why are investors winning? So let's take a look at how things have evolved over the last 20 years. So 20 years ago, this is pre-Zillow. Zillow, believe it or not, there was a time when Zillow didn't exist. So 20 years ago, maybe 1 out of 10 real estate transactions involved an investor. Now it's 1 out of 3. So this is a huge transformation in what's been happening in the market. And this has actually been growing, year over year. And there's a lot of factors that are going into this, a lot of socioeconomic factors from, how people, move more frequently, they're spending less time in homes. And there's a lot of media attention out there. And maybe Colin can speak to this around that, hey, Wall Street's, buying up Main Street. But actually, if we look at it, over 97% of the rentals out there are owned by individual investors. Yeah, maybe Colin, do you want to share anything? You come from having worked a lot in the institutional space. What are you seeing kind of how things have transformed from institutional to individual investors?
Yeah, this graph really does illustrate it, right? I mean, so everybody sort of, again, the headlines have just been Wall Street's, buying up everything, which I mean, clearly they're not. It used to be called mom and pop investors, which now they've sophisticated this into Main Street investors, which they really are. If you look at, 16 million single family rental homes exist in the marketplace. So that's how big the market cap is. With only 3% of institutional guys that are in that space, what they've really done is they've created a bigger opportunity now for Main Street investors, where typically I think most of the SFR single family rentals is sort of spun out of when Warren Buffett spoke on probably MSNBC or one of those. He's like, if I had a way to manage, I'd buy a couple 100,000 of these houses. 2 weeks later, Blackstone, everybody else is just on a massive buying spree. The crux of the entire model was, all right, property prices are, you're 10 cents on the dollar. So it makes, unless there's a massive, the pendulum slides even further south, you're buying pretty much a base level, right? I mean, you're buying a way below base level, I should say. But now the crux really comes into, how do I do sort of all the day two operations like construction management? How do I renovate all these houses, kind of get them back up to snuff, make sure that they're actually, occupiable? How do I find good local property managers, or how do I scale property management, be able to manage these properties? I guess before that was actually find tenants to move into these. So it's great that I bought an asset, but I've got capital slippage going on the day I close on it. So I want to make sure I can get a renter in there, obviously as soon as possible, and a qualified renter. So what Wall Street really did was create this marketplace now for Main Street to now be able to capitalize on all the technologies that have come out, especially like Bold Street, that has really created a community of not only being able to compile property assets, but to analyze them, but also create a community of sort of day two operations of construction managers, property managers, providing courses like this that help educate investors sort of into the marketplace, so they don't trip over their toes, if you will. So I won't say that the market's not incredibly easy. It's not. I mean, this is a business that you have to be well disciplined in, but there are so many resources, and again, like Bold Street, that have created a marketplace that make this much easier and easier to swallow as you sort of want to grow outside of your own local market.
Yeah. So here's another kind of graph to kind of show how things have transformed over the last 20 years. And you can see kind of there's this gradual kind of uptick, and especially around kind of the 2010, 2012 timeline, we're starting to see a lot more investors in the marketplace. And I think directly to what you're talking about, Colin, like 20 years ago, if we look at what real estate looked like 20 years ago, before Zillow, it was a very kind of like the celebrity real estate agent on the billboards, on the park benches and everything. And they controlled all of the information. The investors at that time were very like professional investors. These were individuals that were deep in the space. You couldn't just get into real estate investing without investing an incredible amount of your time. It had to become a second job or a first job to do that. But, very much like what Colin's talking about, the institutions changed that during the kind of 2010 timeframe and they were able to leverage, when in 2008, when everything crashed and all the banks had all of these houses on their balance sheet, they needed to get rid of that. Some of these folks basically figured out, hey, we'll buy these houses. They need to get off the bank's balance. We'll buy them, just like Colin was saying, at 10 cents on the dollar. So they had enough margin to figure out the operational overhead to do that. And that's key, because figuring that piece out, then, so they figure that piece out, and that translated. So now we get to take advantage of that. And what we're seeing now is more people, individual investors, who are not professional investors, who have full-time jobs. Maybe they're tech professionals, maybe they're dentists, lawyers, doctors. They don't want to be professional investors, but they're able to leverage buying homes and buying homes in completely different markets that they may never see that house. They may never even travel to that city and be able to still own real estate in those areas. And just like Colin's saying, leverage a lot of what these institutions pioneered.
Yeah, when you think about sort of what an asset class is, right? So multifamily was an asset class. It took 20 years for multifamily to be considered an asset class. That basically just means of these large private equity funds that are investing and aggregating and acquiring massive multifamily portfolios to now basically it's like clipping coupons, right? We figured out the model. If you buy one, you buy them all. They're all sort of it's a burger fries and shakes mentality. And the single family real estate it only took half of that time, 10 years, to become its own asset class, which is still incredibly amazing when you just think about the ground game that is required to be able to create scale and density in SFR, right? Again, in multifamily, I made this number up, 500 units in one apartment complex that sits on one street. I got one property manager that sits there all day, one maintenance guy that sits there all day. It's a 1 bedroom, 2 bedroom, 3 bedroom. Every pane looks the same. It's all the same, very easy to manage, and I can manage, a few 100,000 multifamily units. Now, single families, every house is different. They're not all the same square footage, right? They have different hardware and materials all on the inside, and not like that. Like, how do you how do you create operational efficiencies with having 300 properties? Let's say in Atlanta. If you've ever been to, I hate to use Atlanta, it's like I was there, but Atlanta, you have travel constraints. So 300 units might seem like a lot, but it'll take you 4 hours to get from one side of Atlanta to the other side, depending on what time of day you go. So when you think about the operational sort of brain damage to do that, these institutional guys, figured out a way to do that. And again, Main Street's now able to leverage a lot of those local boots on the ground experts to do that stuff. So you might find an agent, a property manager, a contractor, or a maintenance guy that's managing an institutional guy's stuff that's also going to be managing yours. So when you really think about that, you're leveraging an awful lot of money spent to figure out this space, in a much shorter and easier amount of time.
Which was a lot of money. In 2022, the institutions allocated $60 billion just for that year. So they invested all this money, and we can kind of leverage that. And I think what's interesting about the multifamily to single family space is the kind of demographics of the US has shifted significantly. So now we've got kind of millennials at having families. They want that single family product. So the single family as a asset to live in has become more and more popular. And because people move more frequently, especially, I mean, people were already moving more frequently. COVID completely upended that with huge migrational patterns, and people want to move more frequently. They're not living in a home long enough to accumulate enough equity for that to really make sense as an investment. So what they want to do is actually rent the house they live in, but then the smart people are buying rental properties to rent to other people. And that's how people are building these portfolios. It's these socioeconomic demographic patterns that are driving towards, single family homes. And now we're in a period that the institutions figured it out. And interestingly enough, where the interest rates sit, they're too high now for the institutions to really buy. So that's why this time period is a very individual investor centric time period that we can take advantage of the best of what the institutions have done and are doing operationally, but we can actually leverage buying homes and creating our own portfolios. So let's take a look. I also want to look at some of the numbers around this. So if you look at real estate versus stocks and bonds, like if we looked at it just from this point of view, we can see, sure, real estate's great. It's consistent. It's better than perhaps bonds. But if you looked at just with no leverage involved, real estate and stocks, you say, oh, well, actually, maybe stocks is better than real estate. However, investors have a triple win when it comes to real estate. One, we get cash flow. You're creating passive income streams. Second, appreciation. And this is often an inflation hedge because these are real products. So real estate appreciates well when there's inflation. And finally, there's huge tax benefits to real estate. When we include all of these angles, this is what makes real estate the most superior way to invest.
Yeah, sort of even just speaking of this and looking at the stock market, right? I mean, buying in real estate, it's passive income from a certain standpoint, but real estate has made more millionaires than any other sector of the market. And everybody just says, well, when's the right time to get in? Again, I've been doing this now for 30 years. I've got, some younger friends that are all like, should I buy? Or interest rates are here. Or whether you're buying your first home, you're buying a rental home, the time to buy is always now. And I'm not saying that from, like, don't want to come across like I'm trying to sell real estate. I mean, I actively still buy properties now. I bought, a fairly high end property when my rate was at 7.25% is what I'm borrowing the money against. Now it's very expensive capital. I wish I would have bought that and locked in a 30-year mortgage when it was at 3.25%. But I thought I had more time. I've also, bought a lot more properties than that. But when I really started to look at the property, yes, the interest rate may have cost me a little bit more, but if I'm looking at just sort of the neighborhood that I bought, and again, I did the math, I did my research analysis, my best case scenario is this going to be a home run? But as far as I go back, and I actually wrote this down from our last conversation, Chris, was again, none of this is a get quick rich scheme. Real estate requires a massive amount of discipline. You need to set reasonable expectations, utilize resources. I'm going to keep going back to Bold Street, plethora of resources out there, but there's so many resources out there now that you can literally cut corners and become much better educated in what you're actually buying than, again, 10 years ago. And I always say the same thing, do the math. I mean, the math is one thing when I see a lot of these real estate people put out these pro formas and they're pie in the sky, they're fantastic. But time needs to be considered into all of your math, your cost of capital, sort of what we call day two operations. Great, I bought that property. Buying the property is the fun part. That's the easiest part. Day two, when I again have to start, getting my construction people out to the house to manage it, I got to make sure my cost controls are there, make sure I'm actually getting my guys to show up on time. Number two is, how long is it gonna take me to rent out this property? Do I have the right property manager? It's great that they rent the property out, but is that tenant they put in there actually going to pay rent? So when I say do the math, it really is sort of using your head in all this and putting in some time into how long each one of these things are going to take, so you can really paint a true picture for yourself. Like Chris, you said earlier, right? This is a lot of base hits. The base hits are fantastic. I'd rather take a whole bunch of base hits. Those home runs will come along, but I'll take base hits all day long. So I guess further to my point about buying another house at a much higher interest rate, my cost of capital is pretty high. But if I'm looking at sort of the market that I bought in, my inventory is low because a lot of people haven't sold, they've already locked in. So my property value is already going up. So even though this is still, I'm sort of bleeding on my capital side, what I'm gonna end up now contracting and selling this thing for, it's gonna work out pretty well. Actually better than I anticipated, which is knock on wood, I'm happy about. But I think that sort of just goes back into one, when's the right time to buy? To buy. It may not be a home run, it could be a base hit, but buy. And two is do the math. I did the math too. I've been doing this for a long time, and I still sort of miss my window. I miss the market as far as like when seasonality was for me to sort of move this property. But still, it's still going to work out in the end.
And I really love that piece because, if I'm on like Instagram or TikTok, you'll see these postings for, you're gonna make millions overnight in real estate and all that. And there's always that stuff, but this isn't that. Like, this is all the stuff you're hearing Colin talk about is the fundamentals of any investing. It's the same kind of stuff you'll hear Warren Buffett talk about, right? Don't time the market, focus on not losing money, like all of the headspace around it. And so that's the piece we like to focus on. And just like Colin was talking about, there's so many tools. We built Bold Street specifically for that, for the numbers piece, being able to do the math, being able to conservatively look at numbers, and then the community aspect of, most folks that we're talking with, they don't want to become professional real estate, professionals. They want to have their own job. They enjoy their job and they want to get better at that career, but you can partner with terrific, amazing property managers who will do all that stuff for you. They'll take over those day two operations. And just like Colin was saying, they come from the institutional space. So they've learned how to do all this stuff at scale, and you get to benefit from that decade of or more of kind of hardcore learning that people went through. So now we kind of get into, everyone's biggest kind of question is, a lot of folks I've heard, they think in their mind, they're like, oh, okay, I really want to get into real estate. I really want to buy stuff, but that's a couple of years down the road. The cool thing about real estate investing, as opposed to just buying as a homeowner, there's so many more options around financing. Here are, some of the ways that you can actually finance different deals, I think.
Yeah, and now that SFR, not to overspeak it, Chris, but
Yeah.
even now that SFR is an asset class, like usually, like when you used to go get a loan for even a rental property, you're really just going sort of to your local bank. You go to Bank of America, Wells Fargo, whatever the local bank was. There are so many now institutional lenders out there that are specifically already lending for this specific asset class. They already know the markets that are being bought in. They're doing this based on rental income, not on personal income, right? So there's DCSR loans, right? So those are debt service coverage ratios. So if you bought multiple properties, you don't have to go the conventional route because you can't get financing in it, or you want to buy it through an LLC. There's so many routes now and so many loan originators out there that you can actually shop rates. I got a build to rent project we were doing for duplexes, and we were just literally picking up phone calls, and we were seeing rates by 125 basis points. I mean, that's a massive difference, right? And a discount. That's just picking up the phone because you just sort of think this is where rates are. I just saw something come across my desk the other day for properties that are like at 3.99% is what the on 30-year fixed. Now, again, I assume that they're probably doing rate buy downs in that. But again, those are, if you find part of this community in Bold Street, just educating yourself or knowing the questions to ask to lenders or even to, sellers or builders, whatever type of product you're buying, that rate buy downs are a terrific way to go. Obviously, when rates have been slightly higher, they're obviously coming down, but rate buy downs are still an option no matter at what rate you're buying it at. So there's a plethora of options now when it comes to financing, and do your homework on this stuff because there's some very favorable rates out there that make this make a lot of sense.
And I think it's just that, and that classic wisdom of don't time the market, because there's all these options out there. If you kind of think about, hey, maybe from picking up the phone, let me just see what's possible. And that's a lot. Well, we'll talk more about the kind of mastermind series that we put together. A lot of that's even if you think you can't afford real estate investing, show up to the mastermind series so we can talk about financing, and then you can actually test it out, and we'll tell you some of the people to call, and then you can actually see kind of what's possible. Because even if you were to buy one house a year, just one every 12 months, imagine in 10, 15, 20 years, you've actually amassed a significant portfolio that's covering all your costs. It could pay for kids, education. It can pay for all your retirement, a lot of different options. Some of them are self-directed IRAs, even 401ks. You can take the money from your retirement account and invest that. So there's lots of different options for financing. One really cool thing is to see how leverage changes the game. So when we were looking at the kind of stocks versus bonds versus real estate, we were not considering leverage if you were just to buy all cash. However, look at the power of leverage. So say we had $100,000 to invest, to use some round numbers. And if all I did was buy cash with that, that's the first investor number one, then I bought a house at $100,000. If I have $100,000 and I use leverage, I can buy a $500,000 house. Now, if we just no cash flow or anything, we just simply look at inflation appreciation of that asset, considering like a 3% annual inflation, then you can see after year one, the first investor has made $3,000, whereas the second investor has made $15,000. That's $15,000 the investor gets to keep. Now that's compounded, 3% annual inflation. We compound that like compounded interest, compounded inflation. And by year 10, we have a significant difference. Now consider also that you've been paying down the principal year after year, and we look at what are the total returns. We can see the total returns are incredibly different. And not to say also that investor two using leverage could now theoretically actually have multiple properties. They reduce their risk profile when you have multiple properties if any given tenant is vacant or something like that. So there's a lot of positives to using leverage, and the leverage is backed by an asset. And that's, and so it's and it creates these outsized returns. So, we want to keep this tight to kind of talk about, the opportunity of being inside of residential real estate. There's a lot of, when you can leverage professionals like Colin, and we've got a whole series of other folks that we pull in from, being across the whole industry, across the whole US. at the institutional level down to brokers that have been doing billions of dollars of transactions. Um, you find these kind of insider strategies when you can identify hot markets like, a Kansas City or a Louisville, Kentucky. Where are the right markets to invest in? Because, they shift over time. And then being able to know the right professionals, getting access to deals flow that's off market. These are all kind of the strategies that you can use that completely change the game. And instead of spending, a decade trying to learn these things, like we've been talking about, using these bringing Wall Street down to Main Street, you can actually access this, right away. And that's what the masterclass is really for. So this is what we're putting together, kicking off in January. It's a 4-week deep dive into real estate investing. And again, this is not to make you a professional around doing this. This is to give you enough knowledge to be able to do this successfully, mitigate and reduce risk, find the right people, find the right markets, determine what are the right buying criteria, how much money do you have access to, how do you actually leverage that money into, larger purchases, how do you build the right team, because that team's those are the professionals you want to use, how do you get access to some of those off-market deals, and then the negotiation process of how do you actually close deals in sometimes competitive markets, how do you get the speed and effectiveness and knowing how to make deals happen. And you don't need to be a professional to do this, but you need to know a little bit. And so that's what really this is designed for. So at the end of 4 weeks, you can kind of be out there actually, in the process of buying your first residential property for investing purposes. We want to include, Colin was talking a lot about community being really important. So we've got a whole learning platform for this. We've got a whole investor community that is growing, week over week. We've got more and more people joining the community. Of course, we've got Bold Street Technology. You get access to this all for free. There's off-market opportunities that different agents, developers are putting into the system. Even some of the big institutions, when they want to sell properties, we're getting first access to that stuff. And then you also get introductions to those key people across the country that are those A players, whether they're agents, property managers, title companies, loan originators, insurance agents, all that. We can save you all the time by getting you connected to those A players. They're going to get you, kind of those returns that you want while mitigating risk. And then I guess finally, the last piece is we are doing a VIP group to this. So the mastermind series is free. So we want you to sign up. We want people in this course learning it. It's a 4-week course to get you in. We do have a VIP piece, which is a more restricted audience. So this is where we're going to go into more depth, additional course material. We're going to do some smaller group sessions. We've got one-on-one kind of access. So say you come up with a possible deal, we can actually work through that with you when you have questions. How do you make a cash flow? Is this the right property or not? And then of course you're going to get pro access to the Bold Street Tech to do all the math that Colin was talking about. So important. And because you made it here, we do have a VIP kind of coupon code here. So if you I'm going to give you the link in a minute. If you use New Year's VIP in the promo code section, we'll reduce it from $99 to $59 a month. It's just month to month, but we want you in the program. And if you're ready to kind of take it to the next level, we highly recommend jumping into the VIP Insider group. So here is the registration. This is a QR code. Let me post the link as well. And I do say we do have limited space because we don't want the class to be too big, because we do want to give you all kind of individual attention. But this is an opportunity for everybody here to jump into this. We recommend kind of sign up now, and we'll send out some more information as we get through towards the new year. And if you have any questions, please put it in the chat. This would be a great time to ask any questions. Otherwise, we'll be available. You can shoot questions afterwards, but this is the time to sign up. You're coming up into New Year's. This is the best time to kind of make a resolution, and not just make a resolution. Plenty of people make New Year's resolutions. January is the busiest time of the year in a gym. If you are regular at a gym, January is the worst month because everybody shows up. But as soon as February rolls around, you're like, this is much better, because then everybody leaves. We're doing the 4-week class because we want to span multiple times. We'll keep you accountable. We'll keep the actions coming so that you can actually make this a reality. And imagine if you start this in 2025, what's it going to do for you 10 years from now? How will your life be different if you have multiple properties that you have investment properties, you have passive income, you've built, you're paying and building equity in this portfolio. How will your life be different in 10 years if you were buying just one property a year? That's what this is designed to do. And while we say don't time the market, this is a great time to do it. So don't waste any time. Colin knows from the inside of seeing this, over 30 years, it's a good time to be in there. We did have one question. What's the minimum amount of capital would you say is needed to get started to acquire your first home? I can answer from my own perspective, and then Colin, if you want to jump in. One of the very first investment properties I did, I actually used an FHA loan, which it's like 3% down. So I think I put it's like, I don't know, like 10,000, maybe $8,000 to $10,000. And so I was able to live in a house for a year and then move out and then rented it out. And actually the first property I bought was $49,000 and I got a mortgage on it. And so, yeah, I think I put, it was like $8,000 for that. So you really don't need a ton of capital to get into it.
Yeah, it's really just a question of what type of property you're buying, right? I mean, I remember the way there were properties in Detroit that were selling for $30,000. I mean, you could have put 3,000, you put $300 down if you wanted to. At the time, I don't know if you wanted to buy in Detroit, but the question is really that sort of big market, sort of specific. There's tons of financing that's out there, right? That can help either lower what your actual initial cost of capital is, your outlay. But again, that still comes down to what the math looks like, right? So it's one thing if I put no money down, but or I say limited amount of money down, but interest rates might be slightly higher. If I'm doing an FHA loan, I'm only putting 3% down, but actually your closing costs are much higher, right? Because you're prepaying for all these insurance things. So again, not to spook in any way, but it's really sort of a market sort of specific and really an investment style specific answer. But you can go into some of these deals with no money down. I really don't suggest that because I think again, you have to do the math. The math makes sense. It makes sense.
Yeah.
I feel like a very sort of washed way to sort of answer that question, which I don't feel like I answered that very well. But again, that's a very market sort of like market specific question.
Yeah. And if you even if you're like, wow, that's a lot, or join the masterclass. And sometimes we need like inspiration to save, inspiration to not get that extra, double frappuccino or whatever,
Look at your DoorDash bill for an entire year, and I will assure you that the amount that you spent on your DoorDash, you can probably buy your first investment property with that amount of money down.
Yes. Yes. Another question, would you buy houses in the same market to build economies of scale or in different markets to hedge your risks?
Again, if you're asking me that question, I think that's more of a sort of a density question, right? So again, that's if your investment goals are to buy a couple hundred houses, right? Again, so I probably want to keep density, right? So in the day I've got economies of scale with the same, property manager, maintenance guy, sort of a burger, fries, and shakes. What the institutional guys have done, and obviously Bull Street as well, is that they have before you used to sort of just buy in your local market. I bought in my community because that's where I could touch it, see it, feel it. My area and expertise was only as far as sort of my local community. Now, literally, you can throw a dart on a map and you can find a plethora of information that's happening in that market. At the end of the day, again, we built a very successful fund but not buying by not being the smartest guys in the room. We just looked where Invitation was buying, where all the bigs were buying, because they had a lot more money, a lot more horsepower than we did. But they were buying those markets. They've already clearly underwrote those markets, so there's something good there, right? We just gotta have to go out and find that. I say the same thing. If there's a new Walmart being built in your area, start looking at real estate in that area because Walmart has done a tremendous amount of demographics and research to know that Walmart will support a tremendous amount of growth. So those are little tidbits of wisdom that you can find and pull out some good information.
Yeah. Yeah. So yeah, and these are kind of some of those insider strategies that we'll talk about in the mastermind class. I'll just say, from my own experience and watching the industry evolve, it definitely used to be, you really needed a lot more density and only buy in one area. There's a lot of, institutional level property managers that operate across multiple markets. And so if you find one of those that are really good, and of course, we know a few, you can buy in their markets. So now you're buying across different markets, and you're mitigating risk because your operators really, really straight, really tight. So those are ways to buy across multiple markets, because now you're increasing your amount of available inventory that you can buy on. So you've got your buy box. If you're just buying in one market, well, there's so much inventory. If you expand that to 2, 3, or 4 different markets, now you've got more possibilities to act on.
It's also sort of a question, or do you plan on self-managing, right? So clearly, if I want to self-manage, it doesn't make a lot of sense for me to buy a house in Naples, Florida, and one in California. It's relatively difficult for me to self-manage those, meaning I'm going to find my construction guys. I'm going to show up at the job site. I'm going to make sure everything is being done. Same thing with property management and leasing, right? So if I'm going to, utilize third-party resources, I think that's what opens up your bill to buy outside of your own market. So you can buy locally and you can buy outside of your market.
Yeah. So what we'll do, there's definitely, I'm a big fan of the crawl, walk, run strategy, where, there's a lot of different, you can tell from just hearing this and hearing Colin's, expertise. There's a lot of things you can do out in residential real estate. In the masterclass, we're going to give you a workable template. So it's a template like, here, let's reduce variables to the ones that we know are the most successful, and have you be able to operate kind of inside those, so that, in the masterclass, it's like your crawl phase. Like, hey, let's buy a property, let's finance it and buy a property and have it operated successfully, that day 2 operations. And from there, you'll be able to kind of build and kind of do your walk and your run as you kind of, evolve in your own knowledge. Cool. Okay. Well, thanks everybody. Thanks for taking some time out of your day. Colin, thanks for joining. This was great
Uh,
having you here. Always
yeah,
great.
this is great. I appreciate it. Thank you.
Yeah. So everyone, so definitely please take this opportunity, sign up. For those of you that are like go-getters and you want to do stuff, like jump into the masterclass. We'll be excited to have you in both spaces, and have an amazing holidays, a great New Year's, and really looking forward to a very successful kind of takeoff for 2025.